Yeah, baby.
Yeah, baby. Yeah. It's your boy Crypto Blood, and welcome to another episode of My 2 Cents, where I cover non-crypto related topics like pop culture, sports, finance, and automotive. Today, ladies and gents, we are going to be talking about an article out of Zerohedge by Nomi Prins. Man, it's been 10 years. I can't believe it's been 10 years, to be honest with you. 10 years since the financial crisis of 2008. And so we'll look at an article she wrote on Zerohedge, going through the details, and really, and you guys already know this, we are nowhere near out of this situation. It's actually gotten worse. So this article kind of goes through that. So we're going to take a look at that. But first, my song request for today, Ludacris, #1 spot. I love this joint. This is off of his The Red Light District album. Throwback for sure. So again, just want to welcome you guys to another episode. Haven't done one in a while, but we're going to get back on it. I had a lot of videos to send you guys, or upload, publish, whatever you want to call it, from the Litecoin Summit a couple of weeks ago, about a week ago actually at this point, out in the Bay Area. It was good to see people, meet up with some of the influencers from the crypto space. So I had a lot of fun, but we're back kind of getting into the routine of things today. So again, Nomi Prins, I read her book Collusion. It was a good book. I think I didn't like who narrated the Audible book. I couldn't get with it. So good book though, detailed how in post 2008, how all of the different central banks and governments colluded together to keep things afloat up until where we are today. But this article caught my attention, man, and I want to really just kind of go through it and have a discussion with you guys about it. So again, out of Zerohedge, title is Nomi Prins, 10 years later, a debt crisis is building again. I didn't know it ever stopped, to be honest with you. The article starts off saying here, though it seems like only yesterday, it's been a decade since my former employer, Lehman Brothers, went bankrupt and in the process helped instigate a massive global financial crisis. That collapse catapulted the Federal Reserve on a mission to, in its own narrative, save the economy from further collapse. In fact, its creation of $4.5 trillion to purchase U.S. Treasuries and mortgage-related bonds from the big private banks in exchange for continued liquidity was the biggest subsidy in U.S. history. In some ways, we seem much better off. Employment is at a record high in most developed nations outside the Eurozone. Global economic growth has picked up overall, and stock markets, of course, we know, have recovered, and that's really ultimately what they wanted. Nothing more, nothing less, just to prop up the stock market. Indeed, many stock markets around the world have regained or passed their former record highs. Asset prices are booming. But that only tells half the story, she says. That's because the latest financial crisis was about debt, and debt levels have increased substantially since 2008. The entire recovery was actually built on debt. From 179% before the financial crisis, the global debt to GDP ratio has jumped to 217% today. Companies and governments have piled on more debt than before. And I just want to stop there and say this, percentage wise, that doesn't sound like a lot, but when you're talking about trillions and trillions of dollars, in nominal dollars, that is a lot of money we've added to our debt in just 10 years. I don't know if she goes through that in this article, the actual amount, but percentage wise, that may throw you off. You may say that's not much of a jump, but it really is. So just keep that in mind. The article goes on to say here, eliminating all that debt is an ultimate solution for avoiding another crisis. That's because if interest rates drift higher, it can lead to problems in debt repayment, followed by defaults, followed by crisis as defaults spread like contagion. But there's no magic bullet for doing that. First, she says you should know that no two crises are exactly the same. The last one was met with huge debt on the backs of the Fed's quantitative easing policy. Central bank credit, or what I call dark money, tended to go to the wealthy and into financial assets. Dark money comes from central banks. In essence, central banks print money or electronically fabricate money by buying bonds or stocks. I remember in her book, she called it was funny, she calls it the money conjuring mechanism. So she called it money conjuring. That was funny. They use other tools like adjusting interest rate policies and currency agreements with other central banks to pump liquidity into the financial system. The dark money goes to the biggest private banks and financial institutions first. From there, it spreads out into seemingly infinite directions, affecting different financial assets in different ways. She says dark money is the #1 secret life force of today's rigged financial markets. It drives whole markets up and down. It's the reason for today's financial bubbles. And I don't know if you guys saw my the panel that I was on in San Fran at the Litecoin Summit. And you know, when I initially got up there, that was kind of what I was saying, is that this whole money conjuring is what Nomi Prins calls it. That this mechanism that they started blatantly in 2008, it's an illusion. Like, that's why all of the banks are doing so well. All these Fortune 500 companies are doing so well, because they're borrowing easy money and then they're going back and buying their own stocks, which of course we know pushes the price of those stocks up. And then in turn, the CEOs and the C-suite individuals benefit from that because their bonuses are based on stock performance. So it's a very perverted system that has been created. It's just unfortunate. And that money, that dark money that Nomi Prins is talking about, it starts with them at the top, and then by the time, and this is what I said at the conference, by the time it gets to us, prices have already risen because those individuals at the top they've used that money has gone into the system and pushed prices up. Article goes on to say here, on Wall Street, knowledge of and access to dark money means trillions of dollars per year flowing in and around the global stock, bond, and derivatives market. Now, 10 years after the financial crisis, there are major complications building with the deluge of debt created on the back of quantitative easing policy. When the next shoe drops for our inflated bubble markets, it will be the debt markets that lead the way. Whether the financial bubble begins to pop in emerging markets, over leveraged corporate sectors, that's what I just talked about, or from overstretched consumers, the reality is that the storm is brewing. All of this is a recipe for another crisis. Meanwhile, a new article lists the warning signs of a recession by 2020. And this was written by Nouriel Roubini. Many of you know who he is, a professor of NYU's Stern School of Business and CEO of Roubini Macro Associates and Brunelli Rosa. Shows why 2020 could be the year of the next financial crisis. It says by 2020, a modest fiscal drag will pull growth from 3% to slightly below 2%. Trump's trade wars will almost certainly escalate, leading to slower growth and higher inflation around the world. Thirdly, growth outside of the United States will likely slow down, especially if more countries retaliate against U.S. protectionism. In addition, China would have to slow its growth to reduce its level of excess leverage in order to avoid a hard landing. Plus, emerging markets can get hurt by a double whammy of trade wars and dollar strengthening. In the event of a correction, the risk of illiquidity and fire sales undershooting will become more severe. That could result in high-frequency algorithmic trading that produces flash crashes, which could hurt exchange-traded and dedicated credit funds. It goes on to say here, the main difference between 2008 and now is that central banks' sheets are dramatically higher. They just don't have the room to accommodate nearly as much easing this time around. Now, JP Morgan, she says, another of my former employees, sees a problem. The crisis, or I should say the next crisis, may become so serious, and recent JPM reports suggest that the next financial crash may be so cataclysmic that the Federal Reserve may have to enter the market to buy up stocks. So let's get this straight. JP Morgan has spent tens of billions of dollars over the past several years buying back its own stock to boost the price. Now they want the Fed to directly bail out the stock market. Call it whatever you want, just don't call it free markets. What all of this means is that the Fed will either stop its current tightening program, re-invoke QE, or get its central bank allies to do the same when necessary. It means that further rounds of quantitative easing through various dark money ploys, in addition to all of the help they've received, will continue. The banks can see no other option. All of those options could prop up the market through volatile periods ahead and drive the current bull market even further. In the long run, this is not sustainable. No one can say exactly when the next crisis will arrive, but there are lots of signs it may be getting close. We know the bond yields are nearing inversion, and I personally think that's a problem. You know, you hear the talking heads on CNBC talking about it's not a problem, but it definitely is, and you should watch for that. But in the meantime, you can take steps to prepare yourself by taking profits and allocating money into silver or gold and cryptocurrencies if signs of a crisis grow stronger. I added that part in there, cryptos. By staying diversified in your portfolio and watching stories like these, you can be well prepared for market turmoil when it arrives. So what do you guys think about that? Like, I agree with her as far as we're definitely right on the cusp of a next financial crisis. However, it usually never pans out the way we think it will. I'm of the opinion that they will successfully kick the can yet again with this next financial crisis, somehow, some way. Like, you got to understand, just like in 2008, they went to extreme measures to keep this thing afloat, because if they hadn't, millions and millions of Americans would have been affected right away, like the next day, that Monday. You know, they did their thing. Hank Paulson, and all the people from Federal Reserve and all that got together over that weekend. And listen, if they hadn't done that, I think that was a good move to do that first bailout. I think it was 1.4 trillion. That's fine. It was 900 billion, something like that. That was fine to put a band-aid on it, you know. But after that is where they just went too far with it. But again, if we have a scenario like that again, they're going to do the same thing, and they're going to bail out these banks and Wall Street again. It's without a shadow of a doubt. Don't think and be so naive to think that the next financial crisis, they'll just say, oh, can't do it. You know, they won't let us do any more. They're going to figure out a way to print more money and kick this can yet again. So what does that mean for those who believe in precious metals, as in what Nomi Prins said? It's not good in my opinion. Ironically enough, like, if they continue to print, what's going to happen is, yeah, the dollar is going to get weaker, but guess what? Where's the money, the easy money going? It's flowing into not precious metals, but into stocks and bonds. So if you're piling up precious metals thinking that you're going to greatly profit from this next financial crisis, you're probably better off piling your money into stocks, because that's where it's going to just hyperinflate into the clouds. Precious metals may go up too, but let's be honest. Do you want to see a 50% increase in your stockpile, or 120%, 200% increase in your money, having it be in stocks? I'm just, that's my thinking. Is it right? No. We're in a perverted situation, a perverted system now. What we thought was right, what we think is right, and sound money and all that is thrown out the door, because we're at the end of a monetary system. So everything you thought you knew is not going to be when you're getting toward the end. So you guys let me know, what do you think? Like, do you think that you know, we're going to see precious metals go through the roof? Now with Bitcoin, with cryptocurrencies, I do think you may see an immediate reaction. Cryptocurrencies are going to outperform even stocks on the way up with this easy money and this hyperinflation. So I personally think, you know, I'm going to be in cryptocurrencies, maybe some stocks, but precious metals will probably be the laggard in performance, in my opinion. So I want to hear what you guys have to say about that. We're definitely on the wrong path, man. It's sad, you know. I don't know when it's going to end, but it is going to end horribly. So you guys make sure you like and subscribe. Make sure you share this video as well. I want to get your feedback on this article as well. I'll link it in the comment section below. And that is pretty much it. It's your boy Crypto Blood, and that's my 2 cents. Holla!